Cam, centuries of data led you to call gold an unreliable short-term inflation hedge. If that's true, what portfolio job can gold perform well?
So again, most investors are not trading with a horizon of 1 day or 1 week or even 1 year. So most investors have longer term horizons. And when you've got a longer term horizon, it gives you a chance for some of that noise in the price of gold to cancel out. So historically, and that's an important word because we don't know for sure what's going to happen in the future. Historically, gold has played a very positive role as a diversifier in a portfolio. So that zero correlation means the market could crash, but the stock market could crash. But on average, you would expect gold to hold its value. Okay, so that something holding their value in a crash-like situation is very valuable. So I would, at some point, like to change the discussion a little bit because we're talking about gold's role as a store of value, as something that's helpful for your portfolio. I would like to pivot at some point to talk about gold as a medium of exchange in the future and the implications of that.
We will definitely have to return to that. Juan Carlos, can you share some of the research that you do at World Gold Council as far as adding gold, and does it improve hypothetical portfolio outcomes?
Yeah, absolutely. And look, I think that it is very important to note a couple of things that Professor Harvey has mentioned. So number one is gold's volatility. And yes, of course, as he mentioned, gold is more or less has an average volatility equivalent to the S&P 500. Now, in fairness, the S&P 500 is a diversified index. So when you measure it against individual stocks, gold actually ranks fairly low, and it's also the lowest, it has the lowest volatility amongst commodities in general. So of course, you do need to take into consideration the volatility that naturally the gold price exhibits. But in the context of broader financial assets, I would say that it's not, a super volatile asset. It's actually maybe kind of like on the potentially lower quartile. But the most important thing is that from a portfolio construction perspective, you need to think about not only volatility of the individual asset, but the correlation. So it's like in the covariance matrix, in the composition of the portfolio, it is the combination of volatility plus correlation that allows you to form these more robust strategies. And look, obviously portfolios, what people are looking to do is to increase returns as much as possible. Our inability to forecast the future, which of course, Professor Harvey mentioned as well, you can only rely on history, but you cannot necessarily know exactly what will happen. Does force you to, or pushes you to look at diversification. One of the things that we have noticed in our research is not only gold's conditional correlation is really low, which is useful, but the unconditional correlation is really low, but the conditional correlation, right, especially when the stock market pulls down, tends to be negative, and that's what you're looking for in a diversifier. Interestingly enough, when the stock price increases, the correlation turns slightly positive. These are, of course, on average, right? So it's not going to be every single day, and so on and so forth. But it does allow you to add an asset that can be a very useful diversifier across different macroeconomic environments, and especially one that can help you when there is a significant pullback in the stock market, and that has been fairly consistent through time. So the research that we've done summarizes gold's role in 3 points. The first one is long-term returns, which is what Professor Harvey was alluding to in terms of the long-term capital appreciation of gold for various reasons, including not only the scarcity, but the use it has as a store of value. The second one is a diversification and kind of like quite effective, contribution to other assets and how they interact. And then finally, liquidity. Gold is an extremely liquid asset. In the OTC market, in the spot OTC market alone, we're talking about more than $120 billion a day traded, right? So it's an asset that you can get in and out fairly easily, especially in financial markets, in the financial market context, which again allows you to use it in periods of risk. So in that context, those are the four tenets of the reason why our analysis shows that gold can help create more robust long-term investment strategies.
Paul, with your CFP hat on, how do you prepare investors for the fact that an asset bought as protection can still fall sharply when protection seems the most necessary?
Well, first of all, in all environments, I'm not always bullish on gold. I mean, when I first started teaching investing in 1983, I was actually very bearish for a number of years during the 1980s. Why? Because gold does not excel in times of stability, in times of low inflation, in times of currency properly managed. In those stable and peaceful times, gold is not a great component of it. So I tell people, but then what happens when that changes? Everything is fine until things change. Right now, it's sunny outside, looks beautiful, the economy looks great, but next week, next month, or next year, all of a sudden there's chaos. So what people have to understand is, again, gold doesn't have to be a major part of your diversified portfolio, but it does occupy, I think, a small segment. For many people, maybe 5%, whatever, more or less. Again, everybody's different, so I'm just giving you a template. But keep in mind that gold is beyond just an investment and an asset. It is a form of insurance, because when those times do emerge, when there's high inflation, high instability, geopolitical crises, then all of a sudden, people say, I'm worried about my finances. I'm worried about what inflation will do with my savings, et cetera, and so forth. And you end up finding out that gold, again, has the role. Again, it's been having a role in people's finances to both minor or major lengths for over 2,000 years. And it survived every currency crisis, every political instability that's out there. So yes, people can tweak how much they hold, but I think having a small amount, and then what ends up happening is that when all of a sudden gold goes through the roof, then all of a sudden people can be able to do something like, well, let me cash out a small portion of it, and I can put those funds over here so I can pay for healthcare and everything else. So as long as you have a long-term perspective and understand the proper role of it, and don't go crazy with it, I think gold does have a part, no matter how minor, in everybody's portfolio. Again, because the world is always uncertain. There's always instability. There's always a risk around the corner. So you want to be prepared, because a lot of other people are not.
Cam, let's come back to your gold's exchange of value and why that's important in the portfolio.
Yeah, so it's really just another way to make the case in the future. So what we're really trying to explain is what to expect. So one thing that we would expect over the very long term is that the gold price should move with inflation over the long term. So this is something that we expect. So again, I said that most of our discussion has been around the hedging properties. And this is not a small asset. So this is a $30 trillion asset. So of course it should be in your portfolio as part of a diversified portfolio. This is really important. Again, I think we should also look at not just the store value and the insurance aspect to it, but the possibility that gold could be used as a medium of exchange in the future. And this has occurred in a small way in this area of tokenized gold. So we know about tokenized dollars, so-called stable coins. Well, now we've got tokenized gold. So this gives you, think of it as a coin that represents a very small amount of gold. So what this does is open the possibility that we could de facto return to an opt-in style of a gold standard. That if you want to deal, if you want to pay with stuff in gold, then you can do that. And this opens so many other possibilities. So the idea of the tokenized gold is that you pay some money and then a certain amount of gold is put into a vault. You've got a token associated with it. But that token is just like money. So you can put it to work. You can easily lend it out. You could put it into an account to earn interest. So we talk about gold as being this asset that doesn't pay a yield. Well, we've got something right now that's operational that is tokenized gold where you can get a yield. And of course, if you've got an ETF, you could lend it out and get something, but that lending out might generate like 20 basis points a year annualized. So I do think that we need to look forward to the future. And this is, even if there's a small probability of using gold as a medium of exchange, that would open a very large source of demand.
Pretty mind-blowing to think about the possible evolution of gold in gold investing. This is a good segue into segment 2.